Got to bring in the other side. All right, that should do it. All right, the hot print that we got yesterday affected obviously the global marketplace. Everything kind of got a little shook up. I know Asia closed down pretty rough. Of course, there's always that knee-jerk reaction, right? Like, I'll say when a bungee cord is stretched to its max before it starts to whip back the other way. That doesn't imply, that we're actually going to go up with any considerable distance. Just when you move that far that fast, you create a liquidity vacuum. When I was looking at the rate hike changes yesterday, they were pricing drastically pricing changes in November, December, and February. And the way that, if you're unfamiliar with using this tool, if I was to only show you this grid, you wouldn't really know, well, what was it earlier? What was it an hour ago? Or what was it yesterday? So you want to get a little more context, right? You want a little more detail. So you scroll down and you can say, ask that question, what was it a week ago? What was it yesterday? So when it was yesterday, I was looking at obviously Fridays, and you could see how much it was changing between where it was through the day yesterday in yellow versus where it was the day before. And those prices, what they did is they pushed that pivot down the road. I believe the streets anticipated rate hike regime plan was something like 75 here, 50 in November, and 25 in December, or something relatively close to that. That was the plan, or it seemed to be that's what they were really kind of pricing in. Now it seems like they're starting to push for, or not push, but they're starting to price the idea that we could get 75 in November as well. And on the September 21, 100 basis points is on the table now, when before it wasn't, right? So there's that. Something to kind of consider when we think about how much everything is going to change, or the changes going on after that CPI print when the market sold off like that. If you're trying to figure out, well, do I want to go long? Should I go long yet? Is it a technical bounce? Are we going to go up? If they're not done pricing in this, pushing this pivot down the road, then we're going to continue to go down. It's as simple as that, right? After they get this priced in, then, we go back to doing what we would normally do. Look at news and earnings and whatever else to focus on. And Japan did like a stress test on their banks. All right, we got a lot of speakers from the European Central Union or the ECB. So you got the EU with Burrell, McCall, and Lane from the ECB. And then Villeroy, however you say his name. And that's it. Now, you might want to keep your eye out for a Fed speaker just showing up on the TV somewhere. If the plunge protection team feels that things are kind of getting a little unstable or out of control, they'll pop up on the news and start chipping their teeth. One time that I remember very clearly, because it's one of the easiest ones to remember where they did this, is when the S&P hit that benchmark 20%, right? When we came off of the high and we had fallen down to that level that everybody was looking for, because you're in a quote bear market if you're off the high 20%, right? Remember that metric that everybody was talking about? Well, on that Friday, when we hit that metric intraday, one of the Fed speakers popped up on Fox Business, started chipping his teeth, and rallied us up off of that low that day. It was an unscheduled visit. We weren't expecting him to be there. He wasn't scheduled to be there. And, you know, it's just another example of the plunge protection team coming in and talking to the public and manipulating people's bias and changing the perspective, right? It's not right or wrong. I use the word manipulation loosely, but I mean, that's what they did. It's what they do. All right, so we went from being on the upper edge of the expected move to coming outside of the bottom of the expected move. Pretty drastic. But when you're asking that question, did we move too far yesterday? Are we oversold? Are we overextended? No, not even close. We didn't move too far. We didn't move too fast. We're not overextended. This range from 4160 to 3960, I'm just kind of, you know, using some rough numbers there. That's what we were projected to do for the whole week. We were supposed to move at least this far. And in a high volatility environment, we very often move more than that. But we're not like 2 standard deviations outside the mean. We're fine. It did move kind of fast when you look at it from that point of view, right? If you got 24 hours in a day and you take off the hour for settlement and swaps and everything else, 23 hours, CPI, you know, is before the 9:30 open. So half a day, we moved very, very far. But if you think about it, we moved really far in like 10 minutes. And then the rest of the day was just a slow grind lower. So it wasn't really that bad. This indicator on the bottom of my screen is a little custom thing that I built, trying to answer a question like that. What this is doing is measuring how far away from the 10-period daily moving average we are. And every market has this distance that it gets to where it says, I'm kind of overextended. I'm getting too far away from the 10. And it'll pause there or reverse and kind of come back towards that 10. Well, if every market has a different distance, then I want to know, you know, what's the distance for this particular market, whatever I happen to be looking at. And I built this indicator to give me that answer. On the ES, we're looking at a year-to-date chart right now. The extreme was 6%, and we tend to flip somewhere past 3.5. So 3.5%. If we look along, you know, right around in this area, it seems to be about as far as we go. We get into that area, I'm usually looking for the market to pause, reverse. You know, I start thinking about iron condors or credit spreads. And of course, it does the upside too, but we don't need that right now. But that's where we're at. Only like 1.25. So not too far, not too far at all. This could easily continue to move to the downside and still not be, oversold or overstretched or anything like that. Not yet. And while we're there, we can also do the measurement for a week and kind of ask the same question. The distance is a little different. It's around 4% on the average, and we're only at 2. So we got plenty of room to move away from that 10 and still not be considered having gone too far. Now, when it comes to measuring things, you can measure really big candles. And then use that measurement to plot your measured move. What I just used here is called the quant tool. It's in the lower left. Hey, Thinkorswim made another new tool. All right, I'll have to get into that later. Anyways, that's where you find it. And I modified mine a little bit. I put some Fibonacci levels in there, but generally you would kind of want to just ignore those and focus on 50% of the move and 100% of the move. Because, if you're doing something like a head and shoulders, a rising wedge, a rectangle, whatever you're measuring, generally it's 50% and 100%. I just figured, why not go ahead and put my Fibonacci's in there so I didn't have to yet again get another drawing tool, and why do it twice? So if you're wanting some kind of measured move to the downside, 3820 and 3700. The last big move was Jackson Hole, right? We all remember that Friday. There's your measured move from that. If we did that on the SPX and not the ES, you'll notice it came right down into that 200 and then based there, right? It was a little bit more accurate, maybe. All right, that's the 200 in purple there, that rejection that we talked about yesterday morning. The previous rejection was on the other 200. I've got the SMA and the EMA plotted here. We are now crossed down and crossed through every single moving average pair. So they're all over our head. There's none, if we're to continue to the downside, there's none that we need to worry about hitting. On the weekly, we can say the same thing because the 200 is not close enough to be worrying about, right? But what that also means is if we do start to rebound this morning and push back to the upside, all of those moving averages are over our head. Now, there is a little bit of logic that talks about how many times you cross through a moving average in a choppy or a sideways or a drastic environment where it just becomes worthless, right? If you're in a good, clean trend and then that price pulls back to a moving average, that usually has some value to it and some merit. But when you're sitting in something that looks like this, once you start crisscrossing it, it just becomes trash, right? So I would approach these daily moving averages with a little bit of caution. They're likely not going to have a lot of merit left to them. It doesn't mean you don't want to know where they're at, just to make sure, no reason to go long 1 point below a moving average just to get whacked and rejected. But I would focus more on the weekly ones. We have two numbers today. The Atlanta business inflation expectations. I mean, everything that's going on is about inflation. And this report today is going to be about the expectations of inflation. Probably going to want to pay attention to what's going on at 10 o'clock this morning. And the other one is PPI. Now, the Fed really likes the benchmark, the CPI, and the rest of us seem to like the PPI. I heard that once. It was interesting because I thought, wow, they're lumping me into that category when they say us and we and they and them. I didn't know that I liked the PPI better than the CPI, but apparently retail traders tend to focus on PPI and the Fed tends to focus more on the CPI. So there you go, right? I don't know. I kind of figure they're both important. And I personally wouldn't put one over the other. That's like saying I like the tires in my car more than the windshield in my car. Well, you kind of you need them both. The volume is not bad this morning at all. We are a little on the heavy side, but not too bad, sitting at around 150. If we look at the average, over the last 7 days, 120 seems to be the highest reading, and 95 is one of the lowest. And the only thing we're using this lower indicator for is we're looking for the overnight volume to be unusual or extreme. So for an example, after the CPI print, you see this very extreme volume. Well, if it was 7:45 in the morning and we've seen that kind of volume, we would need to be a little bit concerned, right? Trying to figure out what's going on. And, conversely, if it's really, really, really low, say 20 or 30, then we'd want to also try to figure out what's going on. A lack of volume implies they're all waiting for something, right? And nobody wants to be the last to know, right? We want to know when something's coming. So it's just a nice little heads up. If we look at this thing down at the bottom and the volume's not extreme and it's not really, really light, we're done with it. It takes 2 seconds. You turn it off, you get it out of the way, and you move on. We are in a missed daily pivot right now. It's called an MDP. That is a trade strategy, by the way, not one of mine necessarily. It's a pretty popular known strategy when it comes to using pivot points in your trading floor pivots. So if you wanted to learn more about that, I'm sure there's plenty of places on the Google or maybe YouTube that will lay out what a missed daily pivot trade strategy looks like. But the idea is, generally speaking, markets tend to hit that pivot point more than 80% of the time. So on days where it does not hit it at all, it actually has some significance to it. The thing I don't like about the strategy, at least what I had come across on it, is it focuses on the day after the missed pivot, right? So for an example, this day was a missed pivot. It would have you focus on this day's trading. So, I mean, that's really my only issue with it, right? And this also was a missed daily pivot, and this would be the trading day that you would focus on. Nah. All right, we are inside of yesterday's price action, which is not a surprise, not even a little bit. So we're inside day. It's a very large day. If we're going to move back up, it could take a week to reclaim that level that we lost or more. So if we do hold and stabilize here, we're going to have to work through all of that, all those pivots to get back up there again. Now, the good thing, I guess, if you want to use that word, is that between 41.75 and 40, we'll call it 40.25, it's going to be a low volume node zone, right? If you think about like a volume profile, and I'll be showing you the volume profile in a minute, there's very likely not a lot of volume inside that area. So when it's a shallow volume area, we tend to move through that relatively quickly, right? And so that's, you know, the only quote good thing out of it. So there is that. What we do want to focus on is we're in a really tight range at the moment. And that means, of course, that we can measure that range. You can measure it two ways. Focus on the range that we had before we broke it last night. Say like, it'd be what we call the IB, the initial balance. The first hour is pretty much what we had for the rest of the night until you got into the kill zone. Actually, that's not even the kill zone, is it? Nope, we're past the kill zone there. So you could measure that and plot it. Of course, I plotted it the wrong way. So I have to flip it over. Wrong pivot. If we're doing the initial balance, it would be back here between the first hour. So that's one way. And all we're doing is basically measuring all of this. And then we had the breakout, its target. That measured move is complete, which leads to the argument that you may as well at that point measure all of what you've got. Well, that of course gives us our upside targets, 50%, 100%, puts us right into the VWAP, the ADR, all of that. You can flip it around, take it the other direction. So that if we do break to the downside, and I'm just going to go ahead and put that initial balance back on. Then you got your downside targets. The 50% lines up with yesterday's low. It's close enough anyways that we could just take that one off the table. The 200 matches 50% of the entire measured move there. So we could take that off, which basically means we don't need that smaller initial balance move. Take that off. Now we've measured all of the Globex. And we've got our top side, 50% and 100%. And our downside, 50% and 100%. Now with the volatility that we've got lately, this is not our trading day. 40.13 down to 39.11, which is a cog line. There's no way that that's all of our trading day. That would just be a good start. It'd give you some near-term pivot points to focus on. All right, it's a little easier to read that way. All right, so I'll zoom into this so you guys get your picture. Remember that these pivot points, the weekly pivot and the daily pivot, they'll become a little bit like a magnet when we get close to it, like you seen yesterday. So if we do break to the upside and we begin moving towards the 200, if we close above 50%, say on a 15-minute or a 30-minute, if we get a candle close above the 50, we're very likely going to go ahead and come up to that weekly pivot point. If we close above the 200, we're very likely going to go to the daily pivot. So it's just levels to target, right? And that's all we got to do, trade from level to level. We do have a 2% ADR right now, but we don't have a market maker move applied to it. And I don't know why there's no market maker move this morning when we know that there's a PPI this morning, but there you go, right? The front end is not showing more volatility than the back end, which is where we would get our market maker move from. The only reason that I could think for that is that the Septembers are still active, technically speaking, and it's throwing off how the market maker move tool works, because that's what the market maker move tool does, is it looks at the front implied volatility and it looks at the back implied volatility. And if the front is bigger than the back, we get a market maker move. Well, game that out a little bit, scratch that one off. Here's the 0-day, scratch that one off. That gives us 28 in the front and 27 or 26.9 behind it. There's your market maker move. So through the morning, keep your eye up here in this area. If there's a market maker move, that's where it's going to show up. Or if you're using the tool, then it'll just pop up here. All right, we're resting on the 786 retrace. So what we're measuring with that Fibonacci is the low down here, Wednesday Globex, and the high of that CPI whiplash. So then we have 25, 50, 75, or 78.6. That's where we stopped yesterday. It's where we are struggling this morning. In the continue to move, if we do continue to move to the downside, then Wednesday's low is what we're going to focus on in that downward target. That would also line us up with the previous week's low, right? Because that's where that pivot comes from. All right, I'm always trying to help people use this tool better. This is cumulative tick. And all of the lines start together in the morning. They all start at the same spot. And then through the morning, they usually spread out. And in a normal day, it's usually like 30 minutes, maybe an hour, and then they start to spread out really well. They stayed really tightly wound all the way up into lunch. And it wasn't until like around 11:30 that they finally started to spread out a little bit. Well, think of that as like a highly correlated market state. We're talking about a high correlation coefficient. If 8 out of 10 or 7 out of 10 stocks generally follow the S&P or the NASDAQ, in a high correlation coefficient, it's going to be closer to 95, 97, 98, 99 names. That's where the alpha protocol play comes in. And of course, we shut it down at lunch, right? Think of the trading day as 3 different zones, like time zones. You have your morning zone, your midday, and then your afternoon zone. The alpha protocol was done by lunch. It was done by the morning zone. And we started to get some divergence here in the upper right. We've got this higher time frame moving average, and it's pointing back to the upside already. It started to turn around 11:30 yesterday when these started to spread out or split apart. The S&P and the NASDAQ continued to go down, but this already started pointing to the upside. Now, I wouldn't go long just because we started to see some divergence here. I'm just pointing it out. Very often, that bullish divergence plays out. But, you know, when we talk about things working 70% of the time, a 1 standard deviation, or better than 70% of the time, we're in the other 30, right? We're kind of in that stage or that cycle where things don't work a lot. So just kind of keep that in mind. So here's the volume profile, 10-day, 30-minute. It's still very, very compressed due to the amount of volume that's in this lower level below the 4111 or the 4011 cog line. Point of controls over our head, and we're in the lower portion of the box. The expectation is that we'll go to the bottom of the box, because that's what we do. When we're at the high of the box, we expect to go to the low. When we're at the low, we expect to go to the high. When we're outside the box, we expect to come back inside the box. I did mention the volume profile having a shallow area right there. Sorry, you guys on YouTube. I will take the Zoom session and upload it to the YouTube, so the replay will be there. I use the OBS for 3 different things, and in one of those things, I automatically mute, which means after I do that, if I don't undo the mute, then the system stays muted. We'll get the replay up there. Takes like 5 minutes. We're looking at a 5-day, 5-minute here. I know there's a lot of lines. It looks very extreme. It's not that bad, really, when you're zoomed in. We have a untouched point of control over our head at 40.04, basically 40.05, right? If you put the rest of the change in there, you'll want to start carrying that forward. We also had a VPOC yesterday at 40.64 that we hit in the pre-market. And the reason that it's still on my chart, because it's no longer an untouched point of control, right? We touched it yesterday. But it's also that June retrace level, that 618. So it's still on there because of the retrace, but it's no longer on there from some kind of VPOC. This one also was taken out, so I'll end up having to move that line today. In fact, I'll probably steal it and put it into this position here at the 4004. $9.13. That's an easy one to remember. It's my mom's birthday. 10/13 is my wife's birthday. What's with everybody being born on the 13th? All right, got the new point of control. So if we're going to start working our way to the upside this morning, we've got to consider that all of those pivots are over our head. 4006, 411, 413, 416. Some of those are cog lines. Some of them are like head and shoulder plot movements. I think that doesn't need to be on there anymore. So the cog line, VPOC, which obviously is not in play, we took it out. Yeah, I cleaned it up quite a bit. extreme move in the dollar yesterday, and it is coming off a little bit, right? It's coming off a little, but it's still very elevated. I've heard from people way smarter than me that, you know, the longer term target in the dollar is like 120, 125. And you can see there is a precedent for that, right? If you think about the dot-com bubble getting burst and how the market was before that, where we were at in the dollar. So, you know, getting up into that 120, 121, that would be pretty extreme. And it also has a precedent. We've been there before. The ramifications of that across the board, I mean, it's just mind-boggling, but there you go, right? So we want to continue to see this kind of flatten off, ease up a little bit. We don't want to see any drastic moves out of this thing today. And we're not talking about just to the upside. We don't want to see drastic moves out of this thing, period, up or down. Calm, steady price action, nothing extreme, nothing crazy. This thing starts to pick up and get crazy, really kind of watch out, right? Maybe tighten your positions up, get in with smaller contracts if you're trading through the day. Consider readjusting your positions. A move down in the dollar should help the rest of the market, and a move up in the dollar should continue to put weight against the market. Now, this is not a teeter-totter system, right? So it's not some inversely weighed correlated market where if the dollar goes up X amount of points or percentages, then the rest of the market has to go down inverse. It's not like that. Think of it more of just a drag or a weight pressing against the rest of the market. And where those pressure points are, they're not always in the same spot. So something to consider too. It's why we watch the grid instead of just watching one particular name. I tend to use the VX futures, but if you want to chart something like the VIX, you know, hey, don't let me talk you out of it. The main thing that we want to keep track of here is where is the VIX? Where's it been? Any levels of resistance? I argued for years that performing technical analysis on the VIX is a silly thing to do that is based on craziness. It's okay to say when you're wrong, right? In the last, I don't know, 2022, through all this craziness when the VIX hasn't been doing what it normally would do, it really started focusing on, again, people smarter than me who I see performing technical analysis on the VIX. And obviously they wouldn't do that if there wasn't some merit to it. And I would look at the outcome of their analysis, of their charting, of their point of view, and it's spot on. You can't argue with what works, right? So I'm going to have to go back and remake a couple of videos. The argument has always been that the VIX is a formula based on basically volume. If you just get rid of all the nerd talk and you put it into like one of those how-to for dummies books, the VIX is like volume of the SPX options. That's it in a nutshell. We don't use volume and then go in and throw on Fibonacci's and MACDs and, you know, quantifiable measurements of pivot points in volume. You ever bring up SPY and bring up the volume and start marking things like that? No, of course not, because it doesn't make any sense. Again, I was wrong. There's more to it than just the SPX options, or there's more to it than just saying it's a volume measurement and that there's no reason to go in and do any of that other analysis. Obviously there is, and you should start doing it. So for the videos that I've made where I talk about don't do it because it's a waste of time because you're measuring volume. Well, let's go back and fix those. All right. Which also, of course, means I'm going to be coming out with some new videos talking about the VIX, because we got the VIX school, right? Those 20 videos. Well, time to make another 5, I guess. Otherwise, energy is maintaining the range. We're still inside of yesterday's, is a good way to say it. We were doing pretty good yesterday. We closed inside of the previous day's RTH session. Just couldn't keep it and broke back out. So now we're inside of yesterday and doing fine. The stability is good, right? It's kind of what we want to focus on. Bitcoin, of course, sold off with everything else, but right now is moving, pretty much the same pattern. It's that H pattern, or that really big bear flag pattern. We're seeing it here. We're seeing it there. We got stocks and bonds were moving in the same direction until the last few minutes here. 30-year popped up, but the S&P and the NASDAQ did not. So they finally just decoupled again. So someone was asking about the MOTs. We've been charting with the NY FANG, right? That generally speaking is a public ticker that everybody else can use, rather than using that homemade one that we were using, right? Because you can use Thinkorswim and put a bunch of symbols in the top and kind of make your own homemade ETF. Well, rather than doing that, we've been using the NY FANG. That way everybody kind of can look at the same name. And the question was, if this is coming into a double bottom here, and the FANGs are pretty much the market, right? Apple, Amazon, Google, blah, 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 go down through the list. If this is coming into a structural pivot point, the rest of the market is coming into a structural pivot point. If we break below this, wouldn't that be a good short? I get the question. It's a fair and honest question, but think a little bit about technical analysis first. So when we talk about a market that is trending, we generally speaking need a full set. And a full set would be 2 lower highs and 2 lower lows. Okay, we have that. Once we print below this low, we will then be starting to focus on a new lower low. I mean, that's like trend 101. It doesn't get any better than that. But for how far? Right? And if you go back to this low, when we broke it, we obviously, we went lower. We got a pretty good run out of it, and then it stalled. When it was this low, and we were setting those higher highs and higher lows, working our way down, we got below that, and it kept going. Right? So is it a good short? Until it isn't, right? Down to, say, the June lows. But there's a difference here between what I was marking back here and what we're marking here. And it's the depth of the move. Tasty Trades talks about moving really fast and then taking the opposite side because of how fast it moved. It's their aggressive contrarian trade setup. Now, generally, we don't get things that look like this. But it's absolutely on the table right now, because they're pricing in those, they're pricing in the Fed pivot farther down the road. So to do that, they have to price in possibly another 25 points for November, because I think they were aiming for 50. If they're now aiming for 75, then they're pricing those in. For December, I think they were aiming for 25, and now they're aiming for 50. So they're pricing that in, right? They're pricing in all along the curve. I don't think they're done pricing in yet. it could be these really big moves, right? Except where are we this morning? We're not lower like we were that morning. We're higher. So we're not continuing with these big bars, which means we would get something that looks more like, say, this, if we continued to go down. All right, we had a big bar yesterday. We are gapped up a little bit in the overnight. So we're going to open somewhere inside that red candle. We could continue to go down, sure. Shorting it from the hole is what we call it. You're talking about going short after we break that low. We call that shorting from the hole. It's valid, but depending on the time frame that you're trading, you're probably going to want to let it prove that it's down there and going to stick, right? Otherwise, you're looking at a double bottom, and double bottoms are supposed to go lower before they rally higher to trap shorts. So just make sure if we do break that low in the NY FANG or in the NASDAQ or in the S&P or whatever it is that you're watching, Apple, Amazon, they all kind of have the pattern. Make sure it's not a double bottom first. Now, how are you supposed to make sure, right? Well, daily close works. So if we break that low, let it close for the day and look at it tomorrow. Don't feel like, oh my gosh, if I don't get in that thing today, I'm going to miss my trade. You're not going to miss anything. We've got a long ways to fall if we are going to continue to fall. And that's what your trade is predicated on, the idea that we are going to continue to fall. So if you're going to short the hole, at least let the market break that level, get your daily close, look at it the next day. If it doesn't rebound back up and begin going back up, there's your short trigger. That has a higher probability or a lower risk opportunity, because then the next day you can get in and you can use that pivot point as like your stop level. We will have been below that and your stop can be up here. Right? That makes sense? Continue to watch those Fed funds. When they stabilize, we can start looking at a market that is going to go back to business as usual at that point, right? It's not yet, but it will get there. And that business could be bearish, it could be bullish. I'm not going to try to imply that I know what it's going to be, but right now the market is only doing this. So all that price action that you see is reacting to PPI, CPI, and that PPI, CPI data is going to directly affect our anticipated Fed funds rate hike. And they're kicking that pivot down the road. So all of these numbers are continuing to change. And until the numbers don't change, when you come in and you look and it's showing that yesterday's and today's are the same, or that it's only slightly different a little bit, then you know that they're done. Until then, if you keep seeing big, drastic changes, 30 points, 40 points, 50-point changes, they're not done. So the market's not done falling. And it's as easy as that. If you're short, that'll help you stay short. And if you're looking to go long, now you know another benchmark that you can add before you try to go long. It's only one benchmark, right? We don't want to look at one thing, say like a candle chart of SPY and say, oh, it's going up, I'm going to go long now. Look at the dollar, look at the bonds, look at this, look at the VIX, look at something more than the one thing you're trying to trade. So this morning we kind of want to ask that question, and I'm like taking a long time this morning for some reason. We want to ask what is up this morning in the pre-market and what's our opportunities. Now remember with PPI, it could be that we get another violent day and that we don't get a lot of insight. Comcast is up this morning, and PayPal, yeah, a little bit. Looks like it bounced off that pivot. And then the rest are a negligible value. They need to be at least 0.5% before I start looking at them. To the downside, Tesla's still down more than 0.5%. So what we're looking at here is the top 20 names in the NASDAQ, because it basically accounts for like 80% of all of the NASDAQ. I was looking at that while waiting for TradingView to get fired up. We can start with something like the heat map. I like this. I used to not like this. When I first started trading, I seen a heat map and I thought, what a childish POS. What a worthless thing. Whoever thought of this, right? Because I mean, at first glance, it just seems like you're absolutely wasting your time. But I was new and I didn't know any better. These heat maps are really, really useful. What I'm trying to do here is adjust this to 100 names. I don't want the S&P 500. I want the S&P 100. And they don't offer the 100 for a choice. So I use the filter by market cap, try to knock it down close to 100 names. And then I change the multiplier so that the colors respond sooner. The size of these boxes are an indication of the market cap. So the FANGs stand out really easy. They're big market cap names: Amazon, Tesla, Apple, Google, Microsoft, blah, 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 blah. So we can see Tesla's down nearly 0.75%. Apple's basically flat, with Google and Microsoft all basically flat. Financials, kind of a mixed bag. We got some that are moving around a little bit, none that are really red. One name doesn't do it. And usually it's I mean, to be fair, it's more the popular names anyways. Chip names, kind of a mixed bag. AMD's down at least 0.25%, and yet NVIDIA's flat. So it gives us a starting point, right? At a glance, just a quick, easy way to see what's going on out there. Then we can jump over to the NASDAQ 100. I don't need to filter this because it's already 100 names. Just adjust the color a little bit. Again, mega cap stands out really easy. Amazon, Tesla, Apple, Microsoft, Google, Facebook, NVIDIA. It's a whole lot of wait and see, right? We're not getting action yet here. This really reminds me of a market waiting on a catalyst. It's like everybody's just waiting for that other shoe to drop. And then we're likely to see the movement. So with that in mind, I don't want to go through a bunch of names. That would be a waste of time as we get closer to the open and everything changes radically. So we're not going to go through the list like we normally would, try to hunt down some names that are gapped up in the pre-market and put together a trade plan on them, because everything is very likely going to radically change this morning as we get closer to the open. Yep, there's just nothing there. So that's it, everybody. Be careful, be safe. For those on YouTube, I'll get the Zoom video loaded. Probably take, as long as the video takes to render. And then I'll get it up onto the YouTube.